All right. So, as I'm
Thank you.
sure all of you are aware, from now on, this semester, we will not be using letter grades unless you specifically request it. Instead, we will be giving pass fail grades. From what I understand of other colleges and how they're treating these pass fail grades, again, this has not been put out by the Virginia Community College system. This is how other public colleges in Virginia are handling the situation. If you choose pass fail, it will not impact your GPA at all. If you choose to get a grade, then you will get the same impact on your GPA as if, you know, it was just a normal semester. So it's important that you realize and figure out what grade you're likely to get before you make that choice. If that is how we handle this and you have a 3.5 and you choose pass fail, you will still get a 3.5. If you choose to get a letter grade instead and you get a B, your GPA will go down. If you get an A, your GPA will go up. So it's important for you to figure out which category you're likely to be in. Also, if you choose pass fail, there's not as much pressure on you to get that A versus if you don't. Just saying, as I know some of you are in some stressful situations at the moment, with jobs, family situations, with um, health care issues in your family or with yourself, it might be better just to say, take the pass fail, just to take some of that stress off. Although it is up to you individually what you do. I do ask that you tell me which one you're planning on doing so that um, I can be tracking that. Because if you decide you're going to do pass fail and you've already passed and you decide not to take the final, which would be your prerogative, I don't want to be hounding you. Hey, you haven't taken the final. If I know that you're not, um, you don't need the final. You know what I'm saying? So does anybody have any questions about that?
No.
Okay. So today we're going to go over chapters 11 and 12. Um, they are very interconnected, and chapter 11 is more foundational, and chapter 12 is more theoretically useful. What I mean by that is chapter 11 will go over a lot of the uh, definitions and how things work, but then chapter 12 is how you use some of those definitions. Like the main thing to keep in mind is things we cover in chapter 11 are facts. This is what these things are. In chapter 12, it's analysis. So you could have two people who have different analyses of the same facts and come up with completely different ideas. For example, you could have two people who look at uh, using the situation we just had. If you have two people who have 800th in the class, and the finals worth 200 points, and both of them have a 3.5, one of them might say, I only need a 50 to get a 50% on the final to get an A, and that'll increase my GPA. So I'm going to go for a letter grade. And the other one might say, if I mess up and have a really bad day when I take that test and I fail it, it will hurt my GPA. So I'd rather take the pass fail and keep my 3.5. Both of them had the same starting point, same information, everything else. When they did their analysis and computed their own risk, they came to different conclusions. So that's what we're going to be going over today, except instead of using grades, we're going to use money. And of course, as normal, if you at any time have a question, please don't hesitate to jump in and ask. All right. So expected returns are based off of every possibility that could happen. When you go in and you say, I expect to make a certain amount of money, for example, you go into work and you're working and you're looking at your paycheck next week and you say, I expect to make $1,000 on that paycheck when it comes in. You are basing that expectation off of every possibility that could happen and your own weighing of those possibilities. It's possible you walk into work today and your boss says, I've recognized your skills and I'm promoting you to management. And so next week you're going to make $2,000 rather than $1,000. It's also possible that you walk in and your boss says, we're shutting the whole company down. We're not having, the CEO was embezzling funds and the government shut us down. So we don't have any, your job is gone. We're sorry. Goodbye. In which case your paycheck next week would be zero. So you are looking, when you plan in the future and say, I think I'm going to make this much money next week, you are taking both extremes and all of the variations in between. Maybe your boss asks you to work overtime. Maybe you get sick and you don't have sick leave. Or maybe there's a power outage and so they shut down the building and you can't work. All those possibilities you are taking into account when you estimate, I think I'll make $1,000 next week. That's the same thing you have here. If you really wanted to be exact about your expected returns, you would go through and list every single possible scenario and then multiply what the outcome of that return for that scenario is by the amount of the probability. And then that would give you your expected return. Of course, that is impossible. You don't have enough time in the day to calculate every possible outcome of even one stock or one investment decision or literally anything. So because of that, we simplify. We pick out 3, maybe 4 or 5, depending on how important it is for you to go in and get exact. How accurate do you need to be? How extreme are the outliers? How closely to the center do they all go? All those things will tell you how many, but 3 is a normal amount. And you pick a bad case, a neutral, which is generally speaking, the one you think is going to be most likely, and a boom. So recession is your CEO embezzled all the funds of the company and there's no company anymore. Neutral is you go to work, you get paid. And boom is you get a promotion. And then you figure out, how likely do you think this is to happen? And then you figure out what would be the case with these stocks. How would they handle it? Are they going to go up? Are they going to go down? In the case of the situation we're having currently, we're probably going into a recession. And if your stock is in a cruise line, you're probably going to lose a lot of money. But if your stock is in a company that makes medical devices, you're probably going to make money because people will know that those companies are going to make a lot of money with this pandemic. So that's where these could be. If you think it's a neutral, you just think, we're not in the recession. This is like, just an average year, whatever. Chances are those two companies would be fare about the same. But if we're in a boom time, you might have, especially respective to the market itself, cruises might go through the roof, But who wants to invest in a stodgy old medical device manufacturer? All they make is these N95 masks. Who cares about that? They're not going. It's not a growth market. It's not anything. They're just going to be stuck. So you go through and you figure out all these percentages. You figure out what your ratio is, and you multiply them all together, and then you add up that, and that gives you your expected return. So you take 0.25 times negative 20, 0.5 times 15, 0.25 times 35. You add those up, and that gives you your expected return for stock A. Do the same for stock B. So you can see that's done here. And so your expected return for stock A is 11%, and your expected return for stock B is 12. And you can see why. Stock A has a much lower or much higher, it has a much lower downside, negative 20, than stock B's downside. But its upside is higher than stock B's upside, but not as much as its downside is lower than stock B's downside. So there's a 10% difference there. There's only a 5% difference there. Therefore, stock B is the safer investment. All things being neutral. If this is where you think it's a recession's 25%, neutral is 50, and boom is 25. One of the things you can look at is the standard deviations, especially when you're looking at the probability of the returns. So what you have here is you have your expected return for everything, and then you're looking at each individual return, and you're putting that into a standard deviation formula. And if you've taken statistics, then that lines it up on like the bell curve, and it tells you how far away it is. Like 60% of all outcomes will be within one standard deviation. This tells you how big that standard deviation is. And that allows you to say, okay, well, what's the chances I become a billionaire off this investment? Oh, that is a million standard deviations. So it's not, that's not happening. So you can go through this. I'm not going to make you calculate any of this out. Just know what it is. Know you can use it. A portfolio is just everything you own that's an investment is your portfolio. That can be your house. It can be a stamp collection, stocks, bonds, treasuries, anything like that. If you have if you loan your cousin $10 and he's supposed to pay you back next week, that $10 is part of your portfolio. One of the things that determine how your portfolio performs is your risk versus return. Generally speaking, things with a bigger risk profile have bigger returns, and things that have a lower risk have lower returns. Your savings account has almost no risk. It's FDIC insured. If your bank goes under, you get your money back. Because of that, the bank pays you, maybe if you're lucky, 1%. On the other hand, you can go online right now and find companies whose bonds are trading at such a discount that the yield can be 80%, 90%. And that indicates those are very risky. All things being equal, the risk return ratio for all stocks, all bonds, all investments is the same. For every bit of risk you take on, you get the same amount of return. So what you can look at is for your expected returns is you figure out what your risk is for all of your you figure out what your expected return is for all of your investments, multiply them by the weight meaning the percent. So if you have 10% of your investment invested in Coca-Cola, you figure out what your expected return for Coca-Cola is, multiply it by 10%. And then that gives you that section for your expected return for everything. If you go through and you multiply everything to get all of your investments by their weights, that gives you a percentage that you add up, and that tells you your expected return for your entire portfolio. So in a case where you have two stocks in your portfolio, one has an expected return of 10%, one has an expected return of 5%, and they both make up half of your portfolio. You take 10%, multiply by 50%, and that gives you 5%. Take your 5%, multiply it by 50%, and that gives you 2.5%. You add those two together, and your portfolio's expected return is 7.5%. Does everybody understand how that works?
Yes.
So here you can see it happening. You have your weight here. 30% of your dollars invested is in asset A. You're expected to make 12.5%. So 30% times 12.5% gives you 3.7 whatever. And then you add all these up together, and you're expected to make 10%. This is just another way of doing it. Is you can do the same thing, combine these two ideas into one chart, and you can use this in Excel where you have all of your likelihood, what's going to happen, what you think your return for each one's going to be, your entire portfolio, and then you can see your expected return. This is also great because it can let you know what is the worst case scenario. What are you looking at? We hit a recession. How is your portfolio going to react to a recession? You're going to lose 3%. If that is too much of a loss, you can't afford that much of a loss, which 3% wouldn't be bad, but just say it was higher, then that can be a sign that you need to readjust some of your stock picks so that your loss here goes up to a respectable level, an acceptable level. You can also look at your boom and go, oh my goodness, I don't have any upside. So you can then also adjust it so that your upside for a boom is better. But if your only three options are these three, it has to be one of these three. While yes, your expected return for all three of them is 10%, the most likely outcome you get is 13%. So your expected return is not the same as what you are most likely to get. It is based off of all probabilities, which you can expect to get. That's a bit of a complicated and mind twisty concept, but if you take, say, the lottery, and they have $1 billion jackpot, you buy a ticket, you're negative $1. 99 million times out of 99 million and one, you're going to lose $1. Well, that one time, your upside is $1 billion. So if you factor all that in together, your expected return off that ticket might be $1.10. But that doesn't mean you're likely to make $1.10. Chances are you will lose $1, but your expected return overall will be $1.10 positive, because that's how high the upside is. So you're not, this is when you're looking at the standard deviation, the big thing here is it's not the weighted average of all the standard deviations of all of the things in its risk, because things have different kinds of risk. Some things a winter storm, big winter storm comes through, dumps tons of snow all over. That will really hurt the sales of hot tubs, but it won't hurt the sales of snowplows. So if you're invested in both, that same risk has opposite impacts on your investments. So you can't just add up all of your risk, total risk, and get an answer, because each one is, because you're diversified, things that impact one negatively will impact another investment positively. Looking at portfolio variance, we're going to skip that. I think this is a little bit more advanced in this class. All right. You cannot predict the stock market. No matter how much you try with this, with all of these formulas, with taking into account everything we go over, you will never be able in the short term to predict what's happening with the stock market, partially because every day there are surprises. Every day there's an unexpected piece of news. A new medicine is discovered. A law gets passed that nobody was paying attention to, but gets passed in Texas that ups the fuel economy standards. A virus breaks out in China. A senator has a heart attack and resigns. We don't know those things in advance. And because we don't know them in advance, we can't price them into the current market price in advance. I mean, you could even have something as simple as a major company, GE, in June of 70, hired 25,000 workers all at once. Just that June, they just hired everybody. And those 25,000 suddenly retire in June, and a bunch of them sell off all of their investments so that they can move to Florida and buy a nice house. Well, the market wasn't prepared for those people just to suddenly all sell off all their investments in GM. So the GM price tanks because they just did. It had nothing to do with the rest of the news. There is no way an investor could know it was going to happen. It just happens. And things like that happen every single day. So prices often, if you don't know about all the news, you just look at the prices, they seem random. But they're not random in the sense that you can go back and you could, with enough investigation, find out every dip and lift in the market. You could trace it back to some cause. But as investors or as businesses, we can't know those things in advance. And most of the times, a lot of the random noise, we can't even know when it's happening. And a lot of it we will never know. So total return is what your expected return would be plus the unexpected return. So we've figured out what your expected return is going to be, but your unexpected return is also in there. And that could be positive or negative. You know, if you're in a medical device manufacturer right now, there's a lot of unexpected positive returns. If you're an airline, there's a lot of unexpected negative returns. Your unexpected return is made up of two parts, your systematic part and your unsystematic part. Therefore, you can say your total return is made up of your expected return plus the systematic and the unsystematic parts. Systematic risk are things that are broad national impacts. Congress cuts the corporate tax rate. Congress increases the corporate tax rate. the U.S. has a booming economy. The U.S. has a depression, inflation. You have interest rates. Um, there's an oil boom. They discover a bunch of oil sitting in uh, the Great Plains, and we've never been able to get to it before, but suddenly developed the technology, and we can get it cheaply. And so companies are rushing out there to start drilling for oil. That can lift the entire economy because all that extra money, all that extra cost, that means the steel is going into them. There's workers, they're buying things, they're building houses, they're doing all this. You could have an entire economy increase based off of that one instance. Unsystematic risk. And now with systematic risk, you can't do anything about it. You're stuck. If you're invested in the US market, your returns are tied to the US economy, period. You cannot fix that. Now, one of the ways you could do it is to then say, okay, well, I'm going to invest in other countries as well. But then that brings in a whole nother thing. So this is just looking at one thing here. Unsystematic risk is things that happen that only impact one industry. That would be like if you have a company comes in and they invent a way of getting us completely off of oil. You know, I've invented a way that we can take and use solar panels to create a fuel that puts in everybody's car, and there's no need for oil anymore. That would be a unsystematic risk to the oil company. You're going to destroy the value of those companies the day that idea comes out onto the market. But, or another one, something to do with a company specifically. You know, we talked about the CEO embezzling funds. That's unsystematic. The CEO embezzling funds is for GM is not going to impact Target. It's just not. They're completely separate. They don't have any interaction. So it's a GM only risk. You know, you have labor strikes, shortages. Right now, what if China can't produce the microchips needed for Intel and AMD? So they can no longer sell their CPUs in the US market because they just don't have CPUs. They don't have the parts that need to go into the CPUs to build the CPUs to sell them. That is very specific risk for Intel and AMD. So how can you get rid of unsystematic risk? You use diversification. If I own only one stock, my unsystematic risk is incredibly high. If I own 1,000 different stocks, my unsystematic risk is basically non-existent. So your total risk is your systematic plus your unsystematic risk. You want to minimize your unsystematic risk because you cannot do anything about the systematic risk. In a well-diversified portfolio investment strategy, the total risk is basically the same as your systematic risk. They're synonymous. Market risk is how much your market fluctuates. One of the big things here is your stock's beta. The stock beta is how closely it mirrors a major index. So if the price of the index goes up by $1 or 1%, how much percent does your stock go up? If it goes up by also 1%, then its beta is 1. If it goes down by 1%, because when the index goes up by 1%, then its beta is -1. The beta for the whole market, therefore, is 1. T-bills have no impact. The price you get for a T-bill, no impact on the market. Therefore, it's zero. Anything less than 1 is less risky. Anything more than 1 is more risky until you get into the negatives, and then, the same thing happens again. So here's some betas for all these. If you notice, the companies that are quote unquote cutting edge or really active with customers and all tend to have betas that are higher than 1. The more established companies you just use every day, your Costco's, your Starbucks, things like that, where you just go in, you buy your stuff, no matter what's going on, you're just going to go buy it. Those have a lower coefficient. So to get your portfolio's beta, just multiply the weighted cost by the betas for all of the items. Your beta plus and the risk premium, what this is saying, well, the idea here is the more risk, the higher your beta is, the more risky your investment's going to be, generally speaking. Therefore, you're going to get a higher premium, more growth, more return for those stocks that have a higher beta in the short term. So your risk reward ratio, it's just your returns, and then your divide by the beta. For the big thing here is for all of them, if you are in a equilibrium, there's no sudden shocks, there's nothing like that, all of the stocks, all the assets will have the same risk return. And then I'm gonna skip through. Okay. Does anybody have any questions about chapter 11?
No.
Okay. Really interesting, fun stuff.
Yes, very.
To a certain kind of person, that stuff they'd be eating it up, and they'd be like, whoa, 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 let's go back and let's learn more. All right. So we're going to look at the when you have cost of capital. Your cost of capital is the amount of money that you have to pay, or the amount of money you lose when you depending on how you fund a company. So one of the things here is borrowing money for bonds. I remember when I was an undergrad, there was one student who he did not make it through the accounting or finance courses. He ended up switching to, like, I think, English. But he could not understand why a profitable company would sell debt. Why would you sell debt? You have to pay it back. Why not just, that costs you money, that's an extra expense. Why wouldn't you just save the money, sell stock or something of that nature that doesn't cost you anything month to month, and just sit there and save up your money, make more money, pay dividends? And the reason why is, if the cost of capital for bonds is less than the cost of capital for equity, it makes more sense to issue bonds than equity. That's the main thing there. If the cost for equity is less than the cost of bonds, you sell equity. Your cost of equity is the return required based off of the cash flows from the firm. So this is how much growth does your investors expect for the amount of risk they're taking on. We went over the dividend growth model before, and you can be rearranged. So instead of required return down here, you can have the required return here. And so you can figure it out. What's the dividend? What's the price? And what's the dividend growth? And that will tell you what your required return is. So here, it's the same thing as the value price and the stock's next dividend required return minus dividend growth rate. That will tell you what the price of the stock is. If you know, but if you don't know the required return, then you can rearrange it so that it's the dividend divided by price plus growth, and that gives you your expected return or required return. So in this case, it has a $4.40 share dividend. It's been increasing at a steady 5%, and the current price is $50. So that means the required or the cost of equity or the retired return is 13.9%. This cost here is for the company because people expect, or in order for to maintain this price, you have to keep growing your dividend, and that's an expense going forward. Sure, you don't have to pay it, but if you don't, then your price is going to go down. So the way you estimate your growth rate, you basically take all of your figure out your percentage and then average your percentages to get your growth. I think that's pretty self-explanatory. The advantage is it's really easy to understand. You can just look at it and get it. Disadvantages: if your company isn't paying any dividends, you can't use the dividend growth model. If it's not paying consistent dividends, you can't use the growth model. If it is the growth rate isn't consistent. Some years they pay the same as last year. Some years they pay less. Some years they pay more. You can't use it. The SML, Smith Mountain Lake approach. You take your risk-free rate, your market risk premium, which we figured out last time or last chapter, and then your beta for that risk, and you put them into this formula, and that tells you your expected return. So if you have a beta of 1.2, current risk-free rate of 7%. Does everybody know what the risk-free rate is? I'm not sure if we went over it in this class or not. Does anybody not know what risk-free rate is? Is anybody paying attention?
Yes.
You're paying attention. Do you know what the risk-free rate is? I can't. Honestly, I just can't remember if we've gone over it in this class or not before. So if we haven't, I can go over it now.
I don't really remember.
Okay.
Honestly.
Risk-free rate is basically exactly what it says. Now, one of the things to remember is when it comes to finance and accountants, we are not very creative people. When you hear creative accounting, chances are it's followed by was sentenced to 10 years in prison. So we name things based off of what they are. It's a shorthand, so we don't have to keep saying it. Risk-free rate is literally what is the rate of a investment that has so little risk that it is so negligible you don't even count it. An example of that is your savings account. There's so little risk because in order for you not to get paid your savings account money, what would have to happen is the federal government would become insolvent and unable to pay. That is such a minute possibility, we don't even consider it. Which leads me to all risk-free rates, generally speaking, are backed by the U.S. federal government, because the idea is if the U.S. federal government becomes so insolvent it can't make due on its commitments, then nothing else matters because the dollar would be worthless. So all your investments would be worthless. The economy would have to be in such a state that nobody cares about your savings account anymore. It's kind of like the apocalyptic zombie apocalypse. In order for the government to stop paying on treasuries, it would have to be a zombie apocalypse where the government just shuts down. And if that happens, why are you caring about whether or not you made money on your portfolio? Wall Street doesn't exist anymore. So that actually comes back to, what is the ultimate risk free? Treasury bonds. What is the treasury paying to borrow money today? And that is the risk free rate. If the treasury is paying 1%, your risk free rate is 1%. If it's paying 20%, your risk free rate is 20%. So when you see risk free rate, just think of that as treasuries. Generally speaking, your midterm, 1 year, 3 year treasuries, like an average of those two, becomes your risk free rate. Your expected market risk premium is 6%. What is the cost of equity? You have your 7% plus your 1.2 times 6, 14.2%. Your disadvantage or your advantages is it explicitly adjusts for systematic risk. It's applicable to all companies as long as your beta is available. But you must estimate the expected market risk premium, which varies, and this is highly sensitive to that. If you come back here and I said your market risk premium was 10%, then this number would be 19. If I said your market risk premium was 1%, this number would be 8. So if I get the market risk premium wrong, which is an estimate, this number changes radically. So you can have two people estimate the market risk premium. One of them says 1%, one says 10%, extreme examples. And this number would be somewhere between 8 and 20. And both of them could back up exactly why they picked 1 or 10. And know, this is why, and I'm right, blah, 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 be able to defend it. All right, so cost of debt is the required return on a company's debt. If you were paying attention to equity, that kind of makes sense. You can compute the yield to maturity on existing debt and use that as your cost of debt, or you can use an estimate on the cost of debt for that what your yield to maturity is going to be for a new bond you issue today. This is more if you're expecting a large, say you have $1 million in outstanding debt in bonds today, and you're going to issue another $1 million, you're doubling how much debt's out there. Method 2 makes more sense. Say you have $1 billion in outstanding bonds, and you're looking at doing $1 million bond issue. Well, method 1 makes more sense. But the point here is the coupon rate is not the cost of debt. So you're going to have to use your when you do this, you're going to figure out what your yield to maturity is, which we did before. It involves a lot of the other kinds of math we've gone over with the present value, future value, all that kind of stuff. The component of debt, component cost of debt is you use your yield to maturity on the firm's debt, but you also have to include the fact that interest is tax deductible. So you take away the taxes. So if corporate tax rate is 40%, for every dollar of interest you actually spend, you only are really having to pay 60 cents, because 40 cents of that would have been had to pay to the federal government anyway, so you don't count it. Preferred stock, it's a constant dividend. You pay it every single year. You have to pay it until basically the company buys back all the preferred stock and retires it. So it's going out there, uh, but it's paid at a flat rate. So you have a dividend of $10. It's going to be $10 forever. So you just take the current stock price and divide that into the uh, annual dividend, gives you your percentage. Now, your weighted cost of capital is rather simple if you remember the portfolios. You take all of your different costs of capital that you have and you multiply it by the weight that the percentage that each one finances your company. So one of the things is you're going to be looking at if half of your company is financed through equity and half is through debt, then it's a simple 50-50. If there's some normal equity, some preferred shares, some debt, and you're looking at, you can even look into all your different debts. If you want to be very precise, you would break out each individual debt, and that would give you your weighted cost of capital. You then compare that to what if we use bonds to finance this investment we want to make? Or what if we use issuing equity? You would then recalculate your weighted cost of capital for each of those, and generally speaking, choose the least one. So here is what I just talked about. You have your weights is the percentage of common equity, percentage of all that cost components, the cost of equity, cost of preferred stock, cost of debt, and don't forget your firm's tax rate. Given all this, you just calculate these out. You would not have to do a very detailed one of these, but just so you know, because companies really do look at this. If you see here, your weighted cost of average for this is 11%. But if you look up here, you can see that debt and preferred stock both have a lower rate than your common equity. And so if you're trying to lower your weighted cost of capital, you could say, oh, I want to issue debt, or I want to do preferred stock. And that would be a common thing. But you might not always want to reduce your weighted cost of capital. If you're trying to get an investor because you need a big investment, you might not be able just to issue debt or preferred stock. You might have to issue equity. And so you want to know, what is your weighted cost capital going to be after you issue this equity? So things, I think you probably can guess what things are going to influence the company's weighted cost of capital. Market condition, tax rates, market risk, the dividend policy, all those things. So there's examples here of how to do it. When you have your risk adjustments, you're just adding in something there to say, okay, what's the risk? How risky is this? And then when you have a weighted, when you look at this, you have your IRRs and you have your project betas, which again, beta just means risk in this case. You look at that and your weighted cost of capital is 15%. Well, that means your IRR is not going to pay for the extra cost of capital. But this project, it would. And then you can look at it, and when you include risk adjustment, that can change your opinions there. That's it. We're not that the last bit there is not as important for this class, but So does anybody have any questions about all the stuff we went through? I know it was a whole lot of numbers, a whole lot of math. But I think if you stop and you think about what you're talking about and you're what it's asking, you could come up with a lot of this information on your own if you just sat there for long enough. So it should be fairly straightforward once you get all the definitions and things of that nature down. Does anybody have any questions?
No.
Okay,
No.
go ahead. Okay. Well, that's most of the people on the recording, so we'll go ahead and stop it now. Again, if you have any questions, please read the book, go over the PowerPoint. If you have any questions, let me know. We'll be having next week, we'll have a quiz over this week's material and next week's material. And don't forget about your course project. If you get it done or you have parts of it done, you can submit them early and I will grade them and get it back to you so you can see how you're doing. And if there's anything I can do for you, please let me know.